Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we look at a sharp and sudden spike in the overnight interbank cash rate. We'll review the latest credit card data, and we'll update what is happening to finance company share prices. And finally we'll wrap up with what the other media are reporting. Regular viewers of this bulletin will know that there is plenty to worry about in the international credit crunch. In mid-August we saw the 90-day bank bill rate in New Zealand blow out to as high as 9.2% at one point, until the Reserve Bank stepped in to ease things. Essentially, banks were hoarding cash, and that was choking our credit system. That intervention relieved things at the time. A more immediate marker for that action can be found in the overnight interbank cash rate. When that August action was taken, the easing was dramatic, as our chart shows. But the international effects just won't go away. In the past few days, that overnight rate has spiked sharply higher. It's part of a wider trend where bank risk premiums are rising. The difference between 3-month LIBOR and overnight index swaps is currently double its usual level. And this could well mean that recent rises in borrowing costs are only just starting. You could argue that so far New Zealand has gotten off pretty lightly, but even the experts aren't sure why that is. It's likely just a timing thing, and new higher costs of credit are yet to hit us. It is clear from the latest credit card data released by the Reserve Bank that before the end of December we'll owe more than $5 billion on our credit cards. This will be the first time the level of credit card debt has breached that level. As at the end of October, that level was $4.9 billion. However, it is usual for balances to rise by more than $250 million in the 2 months of the retail holiday season. It took 32 months for our credit card debt to go from $2 to $3 billion, another 42 months to reach the $4 billion level, and the last push to $5 billion took 38 months. Credit card balance growth has been picking up recently. It was up more than 7% year on year to October. And we've stopped paying off our credit card debt faster. The latest data shows that more than 2/3 of all such debt incurs interest. That is disappointing because credit card interest is amongst the most expensive credit you can have. It is little wonder then that banks raised our credit limits another $125 million in the month of October alone. It's great business for them. It is really tough being a finance company these days, and the stock market is not giving the institutions listed there a whole lot of respect. In 2007, Dominion Finance has seen its share price fall from $2.40 to about $1.60. New Zealand Finance has gone from a high of $1.50 to about 60 cents. Dorchester from $2.30 to about $1. However, they are surviving and probably doing better operationally than the stock markets are giving them credit for. However, the international credit situation hangs over all of them, and sentiment in this sector is not enthusiastic at present. The same problems with sentiment will make it hard for any finance company to gain an investment-grade credit rating, or even for those who have one to hold on to it. But not all are suffering lower share prices. The two Canterbury building societies that are merging and are in turn being pursued by Auckland's Southern Cross Building Society are seeing healthy rises in their share price. And Marrick's parent, Pyne Gould Corporation, is certainly holding its own on the public bourses. Finally today, a wrap-up of some other items of interest. The international credit crunch is having a direct impact on National Australia Bank, owner of the BNZ. It says it will need to hold the mortgage product of Australian originator RAMS on its own balance sheet if RAMS cannot sell it on via the securitisation process it had been using. There may now be no market for residential mortgage-backed securities. The OECD has released updated figures on GDP per capita and modifications that correct for purchasing power. This data compares 2002 with 2005. And while there is no startling new news here, it does confirm that our ranking in this benchmark series continues to fall. We are now ranked 22 out of 30 in the OECD, dropping below Spain and Greece. Although still below us, Korea and some Eastern European countries are making fast progress higher. You can get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.